Hello everyone. In these slides, I'll explain about rules for debiting and crediting. Here, before going into rules for debiting and crediting, here in the previous PPTs already have explained that what is meant by account, accountancy and accounting. And here, what is accounting? Accounting is art of recording, classifying and summarizing the business transaction. And the basic objective of accounting is to maintain records of business and to calculate profit or loss, to depict the financial portion of the organization. When we talk about the depiction of financial portion of the organization, depiction in terms of liquidity, profitability and solvency, and also to make the information available to various group of users. And here in this, when we come to the topic here, for rules for debiting and crediting, under that you should know that system of bookkeeping. Here generally system of bookkeeping has two systems, that is single entry system and double entry system. Single entry system means it is an incomplete double entry and which can be termed as single entry system, and this has been developed by some small business houses for their convenience. And here they keep only the some essential records. And the disadvantages of the single entry system is here, since all records are not kept and the system is not reliable, and this is used only by some business firms, and generally they follow, all the business firms they follow double entry bookkeeping system. Here when it comes to the double entry system, means it is a twofold aspect of the transaction. Here means every transaction has a twofold effect, and here like every transaction is written twice, and once on the debit side and again on the credit side. Here debit and credit will be decided on the basis of nature of the aspect. So here in our economy they follow, it is universally accepted, that is they follow the double entry bookkeeping system. Rules for debiting and crediting. Rules for debiting and crediting depends upon the nature of an account. When we talk about an account, accounts are of three types. It can personal account, real account and nominal account. Personal account. Personal means it is an account which deals with persons. Personal account again are of three types: natural, artificial and representative. Natural. When we talk about natural, it is created by God. For example, like Mohan account, Ram account, this and all, you can take it as example under natural. Artificial. Artificial means it is an account of institution or corporate bodies, etc. For example, here you can take XYZ Company Limited, ABC Company Limited, this and all, you can take it as example under artificial account. And the third one is representative. Under representative, you take all outstanding expenses and prepaid expenses. And this representative account, it is based on going concern concept. What is going concern concept? Going concern concept means here it is, when you start an organization or an enterprise, you assume that your organization is for long run, and based on this assumption you take all outstanding and prepaid expenses, that is you are going to consider all outstanding and prepaid expenses. This representative, this is based on going concern concept. So under representative you take what? You take all outstanding expenses, prepaid expenses, interest received in advance, this and all you are going to you are going to enter under representative accounts. The second one is real account. Real account, here we talk about the assets. And real accounts are of two types: tangible and intangible. Yeah, tangible. Tangible means which can be touched, felt and measured. For example, like cash account, building account, furniture account, this and all, you can take it as example under tangible. Intangible. Intangible, here which cannot be touched, which you cannot feel, the is called as intangible. And examples for this is goodwill, patent rights, copyrights, trademarks, this and all, you can take it as example under intangible. And when it comes to the nominal account, it always deals with expense and losses and incomes and gains. And rules for debiting and crediting. The first one is personal account. What is personal account? It is an account which deals with person, And the rule for personal account is debit the receiver, credit the giver. And the second one is real account, and the rule is debit what comes in, credit what goes out. And third one is nominal account. The rule is debit the expense and losses, credit the incomes and gains. For example, when we take real account, the example like you can take it as goods purchased for cash. So when you are purchasing goods for cash, so here what is coming in, like goods are coming in, and what is going out, cash is going out. For example, if machinery is purchased for the organization, so here what is coming into the organization, machinery is coming into the organization, and what is going out, cash is going out. So the rule is debit what comes in, credit what goes out. Thank you.